Okay, so so that previous segment marked the kind of the sensible normal routine. So I want to talk a little bit about a topic that we started, index investing, and so index investing, and just to fill in a couple of some questions that I was asked as well. So without getting into the long-term methodology and all that kind of stuff, right? So we were for the index portfolio, and you can make this as simple and make it as complex as you want. I mean, there's a lot of things that can be done. So the focus would be in terms of the index. So at the core, we focus on the SPY, partly because that would allow us to benchmark against the its index, right, which is the S&P 500, and we can measure how we're doing in terms of underperformance, which would be not good. If you're matching, which would be a kind of a tie, or if you're beating outperformance, which would be a win. And we know from the research that I did, and all this is available. You can Google any of this stuff. Right? It's out there. If you look at over, and it looks like 20 years is the consensus, right? In terms of looking at timeframes, you can look at 20-year performance, and over 20-year performance, the retail investor averages 2.9%, which is still good. I mean, it's positive. And only 4%, or put it another way, so 96% of pros fail to beat the benchmark index, which is here. And so over a 20-year period, only 4% of pros are able to beat it, show returns higher than that. And obviously, some of the data, some of the articles that you read really do a disservice, because if you look at, they'll say, oh, from like 1926 or whatever, whenever they started, the rate of return is like 11.8% or something like that, close to that. And then if you look at 8.2 to be precise, but if you start the clock around 1950, 1952, I think it is, then the rate of return is from there is 11.88%. So slightly better performance, partly because you've got that big 1929 crash in this period. So, but not, it's not material difference, right? However, if you look at, see, because these are generalities, and the specifics maybe, your specifics may be different. So wherever, like what, 2022, so this year is still, the jury's still out this year. But if you were to go back to, say, December close of 2021, and then you go back 20 years from there to see, okay, how did that 20 years there do? And then go to 2020, and then you go back 20 years from there, and 2019, etc. Go back from there. If you do this exercise, the numbers that you get don't look anything like this. And I went back to, I did this from, I went back to 1985. That's how far I found the data for. If I looked a little bit further, I can probably get more data. So there's 17 rolling 20-year periods from there. And in the average of all of those, well, so the average is anytime you start talking about averages, it becomes meaningless without context, because there's actually three averages. How you look at the mean, the mode, the median. You got to figure all of that out. But in terms of what's interesting is that the lowest return. So look at the ranges first, right? The lowest return was like 3.45%. So still beat. You got a positive return over the 20-year period, but 3.45 is not anywhere close to these numbers, right? The highest return was 9.9%. So that kind of bookends, the low 20 years or the worst 20-year period and the best 20-year period. Again, 9.9% doesn't meet either of these numbers. So if you look at the full range of the S&P index, it's, within the last, since 1985, over a 20-year period, rolling on a rolling basis, the investor would not have gotten these returns. So they would have underperformed the long-term average benchmark. And what this makes even more interesting, because if the actual returns have been lower than these, and 96% of the pros can't beat the benchmark index performances over those years, then that really speaks to how low the returns have been in the market. So this becomes the attraction for stock picking, right? So stock picking systems which promote active investing, right? So they promote active investing, and in order for them to kind of get your attention here, is they're going to sell tools. You got to have the right tools. You got to have the right training, and you got to have the right techniques. And the techniques, are taught in their trainings. So this, and then it's like and then you got to have enough time to master the stuff. So the whole bunch of stuff, and most people are not very successful because we know there's a high attrition rate. We can just study the attrition rate in a couple of very well-known methodologies. You can look at those, and they are very similar to the attrition rate in golf. But by the time the person tries it, gives up, they've already, spent this now, and then they wonder what happened. So the question becomes, right, is how difficult is investing? When we know it's difficult because we've seen real results in Traderboard. Is there a simpler way? The simplest way is obviously to trade the market, just buy and hold. But buy and hold is going to be, you're rolling the dice, because your buy and hold could have gotten 3.45%. You could have had the worst year versus somebody else who could have had the best year in terms of performance. So the probability or the randomness is, there's too much randomness if you just leave it to buy and hold, right? So, which brings it to the key question. First question is always, since you've got the benchmark, is can I beat? So the whole holy grail of investing is to beat the benchmark return of the S&P 500. And typically, it's measured through 2 bull and 2 bear cycles for it to be meaningful. You can't just take 1 month or 1 year. It's not enough data points. And so the 20-year period, matches this one. measures this. But you know, the S&P also has down years. So the other thing is you also want to make sure you're beating inflation in order to get a real return. Otherwise, your money is going down. And then the third thing you need to do is you want to make sure that you're beating on a real term basis, not nominal, real term basis. So that's after taxes. You need to consider the tax scenario as well. So after taxes, are you making headway? Right. You've got to pay, like if you, unless this is in a retirement account or an account where you're deferring taxes, you're going to have to pay taxes. And in an active investment scenario, you're paying ordinary income tax here. Here, you may get an opportunity to be in the capital gains group, so you can lower your taxes. And then over here, you also got higher propensity to have wash sales and stuff like that. Yeah, you may get wash sales, but we would avoid wash sales because the SPY has very similar alternative products that can be substituted in case you need to do that. And then we would look at overall, I think you got to have, and this is kind of getting to the meat and potato of it, right? You got to have different time horizons because different people are different investors are at different stages of the game. People can have different risk profiles, but the most important thing to look at is how far you're away from retirement are you. So if you have more than 20 years left before you retire, then obviously the long range strategy is something you want to focus on. If you're within 20 years of retiring, then you really want to focus a bit more on, give more focus to an intermediate range strategy. And then or if you want to substitute stock trading, then you can do near-term trading. And this becomes a replacement strategy or a proxy for trading stocks, but using the index. It gives you 3 strategies. And then this way, using indexes is a lot easier to identify things like when to be in the market, when to be out of the market, and then and also when you can go invert. You can ride the downtrend using inverses. So you can have long periods of, so you're trying to use the market trends to the upside and the downside. And this would allow you to manage your risk better. Just by having a very simple strategy. Now, you can complicate this by layering on additional things, but as a starting out point, I think to make this simple, you can start out with the SPY